The big question, are these four stocks, CLDI, SUGP, EVOK, and BMGL, a buy right now? I get asked this constantly. The market's been a wild ride, and picking winners feels riskier than ever. Today we'll break down these niche companies from biotech to finance and see if there's real opportunity or just more risk. We'll look at their business models, financial health, and any recent news that could move the needle. By the end, you'll have a clearer picture to make your own call. Grab your coffee, hit that like button, and let's dive in. First up, let's dive into Calidi Biotherapeutics, ticker symbol CLDI, a company that's been making waves in the high-stakes world of biotech investing. If you're looking for a story packed with scientific ambition, financial risk, and the potential for life-changing breakthroughs, this is it. Calidi is a clinical-stage biotech company focused on developing oncolytic virotherapies. In simple terms, they're engineering viruses to specifically seek out and destroy cancer cells, while leaving healthy tissue unharmed. This approach is at the cutting edge of cancer research, and it's generating a lot of excitement in the medical community. What sets Calidi apart is their NeuroNova platform. This technology uses neural stem cells as a kind of stealth delivery system, transporting the cancer-fighting viruses directly to tumors. The idea is to outsmart the body's immune system, which often attacks therapeutic viruses before they can do their job. By using these stem cells, Calidi hopes to bypass those defenses and deliver a more potent punch to cancer. It's a bold strategy, and if it works, it could revolutionize how we treat some of the most stubborn and deadly cancers. But as with all things in biotech, the path from promising science to approved treatment is long, expensive, and filled with uncertainty. The science is promising, but here's the catch. Calidi isn't profitable. Like many early-stage biotechs, they're burning through cash at a rapid pace to fund their research and clinical trials. This is the classic high-risk, high-reward scenario. The company needs to spend big now in hopes of a massive payoff down the road. As a result, the stock is extremely volatile. Prices can swing wildly on any news, whether it's a positive trial result, a setback in the lab, or an announcement about raising more capital. For investors, this means the ride can be thrilling, but also nerve-wracking. One day you might see the stock soar on hopes of a breakthrough. The next, it could plummet if a trial doesn't go as planned. This kind of volatility isn't for the faint of heart. Ultimately, Calidi's future hinges on two things: positive clinical data and eventual FDA approval. Without both, the company's prospects are dim. So, what should you be asking if you're considering an investment? First, how advanced are their clinical trials? Are they still in early phases, or are they approaching pivotal late-stage studies that could lead to approval? Next, how long is their cash runway? In other words, how much time do they have before they'll need to raise more money, potentially diluting existing shareholders? And how does Calidi's technology stack up against bigger, better-funded competitors? The biotech space is crowded, and only the most innovative or effective treatments will survive. Don't overlook management's track record either. Has the leadership team successfully brought drugs to market before? Their experience can make or break the company's chances. For investors, this is pure speculation. The potential upside is enormous if Calidi succeeds, but the risk of total loss is just as real. This is the kind of investment that can make or break a portfolio. If you're considering CLDI, it's essential to do your homework. Dig deep into the science, understand the company's pipeline, and be brutally honest about your own risk tolerance. This isn't a stock to buy on a whim. Remember, this is not a safe bet, it's a true moonshot. The rewards could be astronomical, but so are the risks. Only invest what you're fully prepared to lose, and never let the excitement of a potential breakthrough cloud your judgment. In the world of biotech, hope and hype can be powerful, but reality always wins in the end. Next up, let's dive into the curious case of SU Group Holdings, ticker symbol SUGP. A company that's been making waves on the Hong Kong Stock Exchange for all the wrong reasons. Headquartered in the bustling heart of Hong Kong, SU Group Holdings operates in a sector that's as old as commerce itself, security services. Their bread and butter is providing trained guards for office buildings, residential complexes, and high-profile events. It's a business built on contracts, reliability, and trust. But while the business model is traditional and straightforward, the company's stock tells a very different story. Instead of steady, predictable growth, SUGP's share price has been a roller coaster, soaring to dizzying heights one day only to plummet the next. These wild swings often seem disconnected from the company's actual performance or any news about its operations. So, what's behind this extreme volatility? The answer lies in the stock's low float, meaning there aren't many shares available for trading. When a stock has a low float, even small trades can send the price skyrocketing or crashing. This creates the perfect environment for speculative trading, where momentum and hype can override fundamentals. This kind of setup attracts a very specific crowd, momentum traders and speculators looking to capitalize on short-term price movements. But it's not a playground for everyone. There are significant risks. Foreign accounting standards can make it hard to get a clear picture of the company's finances, and the political climate in Hong Kong adds another layer of uncertainty. Add in unpredictable trading patterns and you have a recipe for potential disaster. For those who care about the fundamentals, the key questions remain. Is SU Group Holdings actually winning new contracts? Are they growing their revenue and keeping costs under control? Unfortunately, transparency is limited. Financial statements may not always tell the full story, and language barriers or unfamiliar regulations can make due diligence even tougher. If you're watching this stock, keep an eye out for any news about major contract wins, changes in management, or regulatory updates. These can sometimes explain sudden price moves, but more often than not, the stock will move for reasons that are hard to pin down, leaving investors scratching their heads. For most investors, this level of volatility and lack of clarity is a major red flag. It's easy to get caught up in the excitement of big price swings, but the risks are real, and losses can mount quickly if you're not careful. If you're a trader who thrives on momentum and volatility, just remember, the same forces that can deliver quick gains can also wipe out your investment in a flash. It's a high-stakes game, and the odds aren't always in your favor. For long-term investors, the story is even more sobering. The fundamentals of the business, low margins, intense competition, and limited growth prospects mean that even if the company performs well, the upside may be limited. Caution is not just recommended, it's essential. In many ways, buying this stock is like buying a lottery ticket. The business itself is steady but unremarkable, while the stock price behaves unpredictably, driven more by speculation than substance. For most, the odds simply aren't worth it. Unless you have a compelling reason and a very high tolerance for risk, it's probably best to steer clear of SU Group Holdings. In the world of investing, sometimes the best move is knowing when not to play. Third, Evoke Pharma, Evoke. Unlike CLDI, Evoke has an FDA-approved product, Gimoti, a nasal spray for diabetic gastroparesis. The innovation? Delivering a known drug via nasal spray, helping patients who can't keep pills down. The challenge: slow sales growth. Despite approval, prescription numbers haven't taken off, and the company isn't profitable yet. Key factors: can they ramp up marketing and convince doctors and insurers to support Gimoti? Competition from cheap generics is fierce. Cash burn is a concern. If sales don't accelerate, dilution or worse could follow. Watch management's updates on prescription trends and insurance coverage. This is a turnaround bet. If sales inflect, the stock could be undervalued. If not, it could go to zero. Success depends on execution, not just the product. Patience is required. Turnarounds take time. If you believe in the team and the product's edge, it's a speculative buy. Otherwise, it's a wait and see. Last up, let's talk about Basel Medical Group, often abbreviated as BMGL. This company is the latest entrant in the Asian medical distribution scene, and it's already turning heads, not just for what it does, but for how little is actually known about it. In a sector dominated by established giants, BMGL is the new kid on the block, and that alone makes it worth a closer look. BMGL is a relatively new and little-known medical distributor operating primarily in Asia, with its headquarters in Malaysia. The company recently went public, but not through the traditional IPO route. Instead, it used a reverse merger, a shortcut to the stock market that often raises eyebrows among investors and analysts alike. The core of BMGL's business is distributing medical devices and supplies. They act as a crucial middleman, connecting manufacturers with hospitals, clinics, and other healthcare providers. This role is vital in ensuring that essential medical products reach the people who need them, especially in a region as vast and diverse as Asia. Success in this industry depends on two things: securing exclusive distribution deals with reputable manufacturers and running a tight, efficient logistics operation. However, when it comes to BMGL, details about their contracts, supply chain partners, and operational strengths are frustratingly scarce. This lack of transparency makes it difficult to assess the company's true competitive edge. The reverse merger process, while faster than a traditional IPO, often means there's limited financial history available for public scrutiny. For BMGL, this translates to a lack of audited financials, minimal disclosure about past performance, and very little information about the company's long-term strategy. For most investors, these are major red flags, signaling a need for caution. The stock itself is highly volatile. With low trading volume and almost no institutional support, BMGL's share price can swing wildly on even small bits of news or rumors. This kind of volatility can be exciting for day traders, but for long-term investors, it's a recipe for sleepless nights and unpredictable losses. There are still many unanswered questions. What specific products does BMGL distribute? Are they focused on high-margin innovative devices, or are they simply moving generic supplies? Who are their key partners and clients? Without clear answers, it's hard to judge the company's growth prospects or its ability to compete in a crowded market. Another critical factor is management. Is the leadership team credible and experienced in the medical distribution field? Do they have a track record of building successful businesses, or are they newcomers themselves? The answers to these questions can make or break a company's future, especially in a complex, regulated industry like healthcare. BMGL's future growth will depend on its ability to expand its product lines, enter new markets, and build lasting relationships with both suppliers and customers. But the risks are significant. Potential accounting issues, undisclosed liabilities, or simply weak business fundamentals could derail the company's ambitions. Investors need to be aware that what looks like a promising opportunity could quickly turn into a costly mistake. For most investors, the combination of limited information, high volatility, and uncertain management makes BMGL a stock to avoid for now. There are simply too many unknowns and too much risk for the average portfolio. If you're still interested, be prepared to do your own deep research. Dig into every available filing, scrutinize management's background, and understand the risks of investing in a company with so little public track record. Extreme caution is not just advised, it's absolutely essential when considering a speculative play like Basel Medical Group. So, what's the bottom line? CLDI is a high-stakes biotech gamble, huge upside, huge risk. SUGP is a volatile Hong Kong security company more suited for traders than investors. Evoke is a turnaround story, betting on their ability to sell Jamodi before cash runs out. BMGL is the riskiest, a new, opaque medical distributor with little track record. Do your own research, know your risk tolerance, and never invest more than you can afford to lose. If you found this helpful, like, comment, and subscribe for more deep dives. Thanks for watching.